Welcome to Forex TV's PM Exchange. It's Thursday, November 1st. I'm Remy Hoki. Today we're joined by Joseph Trevisani from FX Solutions. Good afternoon, Joseph.
Good afternoon, Remy.
Thanks for joining us today.
My pleasure as always.
Well, in today's session, the U.S. dollar has recovered from weakness seen in yesterday's session against most majors, and euro dollar hit a new high against the euro yesterday. But ahead of the non-farm payrolls, what's your take on euro dollar?
The euro's had a very lovely run. I mean, if you can go back, actually you can go back 7 years on this, but let's just be logical. Let's just go back 1 year. What's in the euro right now, from a profit point of view, from a speculative point of view, does not seem to be sustainable. Will the market come to this conclusion on its own without a trigger? I doubt it. Is there a potential trigger? Yes, there is non-farm payrolls tomorrow. With ADP report today was considerably better than expected. There's some risk on the upside. The median for non-farm is probably around 80. I would probably go a little higher. I would look 100, 110, and if you get anything above 110 or 120, it will definitely help the dollar. It should be the occasion for some profit taking in the euro.
Okay, let's move on to the sterling against the dollar, another high-yielding currency. So we saw a sterling top at $2.0870 today. So going into tomorrow's session, what's your range for sterling against the dollar?
The sterling, I think, is probably a little less likely to have any profit taking, primarily because the comments out of the MPC, the policy board of the policy arm of the Bank of England, have been surprisingly strong as far as rates go. They seem more concerned about inflation than it was in the market expected. Based on that, there isn't going to be much speculation that they're going to pause or cut. So therefore, what we're looking at is probably 20750 to 20950. There's still some more upside pressure, I would say, on the sterling and probably on the sterling crosses as well.
Okay, in today's session, equities have taken a hit here in the U.S. and the Dow fell over 360 points. Well, given the volatility and risk aversion, the yen has gained. So briefly, if you could give us your ranges for the yen against the other high yielders as well as the dollar.
The fall in the equities today, I think, is primarily tied to corporate profits. I mean, it's been one of the things that has been driving the equities market. Certainly, the fall today was precipitated by Citibank. I mean, Citibank is a financial stock, obviously, but it is very closely tied to the financial and credit market problems that began in August. So even though that is weighing down the stock, I don't think it's going to have long-term equities, any long-term effects. For the yen, I'm looking for, as I said, a trigger in the euro, and that would be a trigger in the dollar as well. So I'm looking actually for the dollar probably to strengthen over the next 2 weeks, 114 to 116.50. Again, the point being, it is overdone, I think, based on the information that we have.
Okay, well, now that we have the event risk of the FOMC out of the way and non-farm payrolls today, we will be getting 2 more non-farm payrolls releases before the next Fed meeting on December 11th. But if you could briefly take a step back and tell us about the Fed's bias in their statement yesterday.
The Fed was very careful, as they always are. You can look at the interesting thing, I think we've mentioned it before, about the supposed Fed bias is that there really isn't such a thing. It is a matter of interpretation of various commentators on what is actually in the Fed statement. My take on this one is that they have shifted again to a very firm neutral stance with the anticipation that if supported by the statistics, they are still more concerned about inflation. This reads to me as slightly hawkish, but not enough at all to put a scare into the markets. I don't think they want to excite any expectations about their next move. They're willing to let this one play out.
Well, speaking of inflation and central banks, the ECB and BOE announced their rate decisions next week. So if you could give us your expectations for the BOE and ECB next week.
I don't think either one of them is going to raise rates. I don't think either one of them is going to lower rates. There's going to be speculation on both sides that what you're going to get is a more hawkish statement, much as perhaps with the Fed at the FOMC yesterday. But neither one is going to have any good reason for taking any particular move at this moment. The odds and the weights in the market and inflation are pretty well balanced right now. There's a good deal of risk on the economic side, and there's clearly some resurgence in inflation. We've seen that in the latest ECB numbers. So I don't think they're going to do anything, and I think they're going to come down, as far as their statement goes, harder on inflation.
Okay, and last but not least, investors are faced with end-to rate cuts here in the U.S. in the near future, and also the prospect of a slowing economy, possibly a recession. And today the Fed Reserve did pump $41 billion into the system. If you could briefly tell us about this and how this affects the U.S. dollar long-term forecast.
The liquidity injection by the Fed today was interesting. I mean, it is as clear a signal as you can have, and certainly the equity markets took this as a signal, not only Citibank's numbers out today, that things might not be as clear or as over in the credit markets as they might hope. If they are not, then you are going to get further declines in equities, and you're going to get further damage to financial market stocks. Whether this will have an overall effect on the economy, I do not think so. I don't think that the economy is going to be suffering. Wall Street gets very good play in the media. We all like to talk about it. But its effect on the overall economy is relatively limited, especially for these types of financial instruments. Be that as it may, the economy has had a long string of bad news, even if it hasn't had much of a string of bad numbers. I think you're going to have some play out for the psychological effects of what we've seen over the past three months. I don't think that it's going to last beyond the fourth quarter, and I would again look for continued strength and some recovery in the dollar, certainly first quarter next year. Of course, it may not turn out that way.
Okay, Joseph, as always, thank you very much for coming on the show today.
My pleasure, Remy. Thank you.
This has been your Forex News with Joseph Trevisani from FX Solutions. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks tumbled in today's session with the Dow ending in the red, lower by over 360 points. Financial stocks tumbled after Citigroup and Bank of America were downgraded by CIBC World Markets. In the first trading day of November and the first session since another Fed funds rate cut, investors weighed the latest economic data and the possibility of an end to rate cuts, which were compounded by weakness in the U.S. economy. Earlier, the ISM reported that manufacturing fell to 50.9 in October, the lowest in 7 months, and also down from the 52 in September. Meanwhile, September personal incomes rose 0.4% month-on-month, and personal spending by 0.3% month-on-month, and the core PC price measure was unchanged at 1.8% year-over-year. The Dow Jones Industrial Average tumbled 362 points to end the session at 13,567.87. The tech-heavy NASDAQ fell 64.29 points to end at 2,794.83. And the S&P 500 ended down in the red by 40.94 points at 1,508.44. In the fixed income market, U.S. Treasury bonds climbed as U.S. equities tumbled. There is a rise in the appeal of bonds due to risk aversion in the market. The benchmark 10-year Treasury note was up with the yield down 2.5% at 4.352%. The 30-year bond was up with the yield down over 2% at 4.638%. And in energy, NYMEX crude oil futures pulled back from a record high of $94.53 a barrel in the previous session. At the end of today's session, December crude ended down by $1.04 at $93.49 a barrel. In earlier trading, the contract hit an intraday low of $92.10 a barrel. And in other NYMEX petroleum products, December RBOB gasoline added 5.5 cents to end at $2.3425 a gallon. December heating oil fell 1.72 cents to end at $2.5121 a gallon. Meanwhile, U.S. natural gas supplies rose 66 billion cubic feet in the latest week. This according to the EIA. At the end of today's session, December natural gas was up to 29.2 cents to close at $8.622 per million BTU. Over in the metals complex, gold futures ended down, seeing renewed pressure on the day. With the U.S. dollar recovering from weakness against the euro, gold showed slight losses. December gold lost $1.60 to close at $793.70 an ounce. December silver lost 11.30 cents to end at $14.325 an ounce. And December copper fell 11.5 cents to end the session at $3.3625 a pound. Meanwhile, December palladium gained $1.65 to $375.90 an ounce, and January platinum added $3.20 to close at $1,450.80 an ounce. This afternoon, we're joined by Derek Fry, head trader at ONF Futures and Options. He'll recap today's session in energy and metals futures.
Okay, to recap the action we've seen in the metal and energy sectors today, I'll start with crude oil. We see continued upward pressure in this market even after the big pullback that we saw yesterday. We see more upside today. I mean, it continues to be the same story that we've all been hearing: geopolitical tension, continued soft dollar, and just overall kind of bullish fever surrounding the fact that we are ever so close to that mythical $100 a barrel level. At this point, the path of least resistance is clearly to the upside, although risk is very high at this price. If you're not already long, getting long up here is a very dangerous proposition because it's very likely that we'll have some sort of a pullback in the not-too-distant future. So, again, like I said, past resistance is higher. So if you're willing to take a shot at it, you very well see a push to $100, but I wouldn't get too comfortable with any long positions at this high price. Be very, very careful and looking to hedge with some puts at the very least. Looking quickly at gold, kind of the same story there: geopolitical tensions as well as a dollar that's been willing to find any support, at least thus far. Continues to push it towards that also somewhat mythical $800 level, and just above 800, of course, is the 1980 highs, the Hunt Brother highs, as they're sometimes called. And we'll see if those levels are tested. I do think you will see those levels tested in gold, frankly, in the not-too-distant future. But also in the very near term, both markets, I included a chart here, and chart is three markets overlaid into one chart. The top one is crude oil, the middle one is gold, and the bottom, the black and white, is the dollar index. You'll notice that the crude oil and gold are very highly correlated, and at the same time both markets inversely correlated to the dollar. You'll also notice that they're both at a very extreme, the gold and crude oil are at an extreme point away from the dollar index, and it could be a sign that we could see these kind of revert more towards the mean. In other words, you could see dollar strength. What it's going to take for the dollar to find support is some sort of real financial support from the Fed. We did see the beginnings of that last night with them infusing some capital into the system. One of the biggest things that we would look for, frankly, is if the Fed announces that they're buying back treasuries. That would be very supportive for the dollar in the near term. It's very similar to what you've all seen over the last few weeks or months in the stock market, where companies have done stock buybacks. The same kind of thing for the government. If they do treasury buybacks, it's essentially very supportive to the dollar, much like a stock buyback is supportive to the underlying stock. We've reached a very extreme point in the bearish sentiment towards the dollar that's usually indicative of a reversal point, so I definitely urge people to keep one eye on the dollar at all times, and if we start to see strength there, it will be a signal to get out of long positions in both metal and energy sectors.
That was Derek Fry, head trader at ONF Futures and Options, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.